Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project Podcast. I'm your host, Steve Fieros of Tri-City Equity Group. Today we have Hadar Orkibi on the show. With me is my co-host, Vince Gattings.
Hey, Steve. Super excited for this show. Hadar is a co-coach with me in the Jake and Gino community in the Wheelbarrow Profits Academy. Very knowledgeable on asset management. We have a lot of the same, very similar minds and thought processes of how we work through problems and the systems we set up. Both of us started long distance investing. So the way we solve problems are always through the lens of being a long distance investor. So it's always great to bounce things off of him and see his perspective on how he's solving very similar problems, how we solve and deal with problems that we have, or look for opportunities in our deals and in our processes as well. So definitely a lot of good information. Just a couple quick hits on that. We're going to talk about the importance of lender relationships, stress testing, KPIs for asset management, and just takeover process acquisition. And he has this 5-step plan through his project with Marco Barbaro. And it's the 5-step process that he has in the MIH Mastermind. So he's going to hit on that too, which is also a lot of golden nuggets in that as well.
Back then in the early 2000s, real estate was quite cheap here. The exchange rate from the US dollar to the Kiwi dollar, if you like, was very attractive. You can get good bang for your buck when you're buying a house. We couldn't believe what we can get. So we decided to immigrate, and I decided to continue with my passion to real estate, which started growing through seeing back in the early 2000s what really was going on globally. Real estate became on the upswing from the last boom, if you like, in the early 2000s until the global financial crisis. I started wholesaling, started building some deposit. When I mean wholesaling, I did a lot of assignments, contemporaneous closing, which is double closing, and gradually got up from deposit and I started flipping houses to make more money. When you buy, renovate, and sell, you make more than 5, 10, 15,000. You can make 50 or 60 or 70 or 100. Because the numbers of the prices of houses in New Zealand are higher. We don't have houses here for like 30 grand, 40 grand, 50 grand. It's more like Hawaii, if you like, more like Boston, LA. Now the market really matured. Later on down the track, I started building my own portfolio. So I bought some small multifamilies and commercial real estate. And about 4 or 5 years ago, I got to the point when my portfolio appreciates significantly, but I'm really in a position that everything else that I want to buy will produce a very low cap rate, very low cash flow returns. So as an American citizen, I started researching the market, researching education options, and I found Jake and Gino, which Vince and I both coach for, and became educated through Jake and Gino. I met with Gino in St. Augustine. I done my market tour to decide which market I want to invest, but I made the point to visit Jacksonville, Florida, which was back then very interested to me, and met with Gino and really started to slowly get my feet wet after completing the education. I bought a small multifamily and gradually started investing and sourcing and applying my wholesaling strategies and knowledge to take down opportunities in the States, and gradually started building a portfolio. Now I still coach for Jake and Gino, but I also facilitate the MIH Mastermind with Marco, as you can see here, which is Gino's brother. And we by taking down some opportunities, we're buying, for example, we're going to close on a 20 lots mobile home park in Nashville this month. And since then, I bought another 45 units in my market in Arkansas late last year, which was a great value-add opportunity. And, just really full-time concentrating on the States for cash flow. But also I have a flipping business in New Zealand, which is doing very well. And I'm kind of managing it, quite kind of remotely. I got boots on the ground there and I've been doing it for nearly 20 years now. So It's semi-automated, so it doesn't require a lot for me, but it does generate significant of my W-2, if you like, in New Zealand. That's how it's structured.
That's awesome. I mean, what a background. You've got such a unique, I think, vantage point. I mean, for one, being so much experience internationally, traveling, kind of getting a feel for different places around the world. I feel like that's an experience that a lot of, let's say, Americans don't necessarily get or appreciate. The opportunities that are available here. Of course, listening to any local media now, it's all doom and gloom, and but there's so much opportunity here. And I always feel like it takes that kind of outside perspective, unless you're very intentional about seeking out that opportunity, to understand that. So you mentioned, I mean, obviously you've got hands-on in a few different places. Where are you actually based out of right now then?
Now I'm currently in New Zealand, in the South Island of New Zealand, which
okay.
is there's two islands. So the North Island is more populated. There's let's say 3.5 million people live over there, and the South Island, it's the one that they filmed most of the Lord of the Rings, and it's very spaced out, and there's a lot of scenery, and it's beautiful, and the adventure capital of New Zealand, which has all the bungee and all the attractions there. That's an hour for me. It's a Queenstown. The South Island's got only like a million and a half people now, and it's very, very relaxed, very nice, very safe place to live. But I always been investing out of area. So even in New Zealand, we've been in the South Island since we decided to settle down and buy a house here. I was settling in the South Island in an area in a small town with 4,000 people. So I was basically self-educating myself how to invest out of area. I basically had to adjust and learn to build teams and be prepared to travel and be good communicator to brokers, to potential sellers in order to create deal flow. So, it just came quite naturally for me to scale up and move to investing in the state. Although the travel is, instead of traveling 2 or 3 hours, an hour to the airport and then an hour or 2 flights, depending where you're going in New Zealand, now I need to travel 2 hours to the airport and then fly 15 hours or something like that. So it's a mindset thing, you see. But once I decide, I was preparing to go all in and spend some time in the state. Each time I go to the state, I stay there for at least 2 or 3 or 4 years. If I got a deal there and I need to work on it, and for example, in my latest deal, I had delays in closing. I just keep pushing my ticket out and extending my stay. And, I'm doing it for my family. I'm doing it for better opportunities for my family. My whole purpose is to create a cash flow machine, if you want, in the States. The cash flow in New Zealand is good. I got properties which are unencumbered and there's no mortgage on them. And some of them are generating good income. But if I want to grow that asset base to a level which will be really long-term generational wealth for my family, I had to go and buy assets which are generating significant cash flow with relatively favorable funding and financing terms as well. Because in New Zealand, especially in my market, which really matured now after nearly 20 years of investing there, like I said, they are like Boston, New York, Seattle. The cap rates are compressed. The median house price in Auckland now, it's $900,000. So if you want to buy a duplex or a triplex or a quad, which is the majority of the multifamily in New Zealand, that's what they are. There is no purpose-built apartment communities like we have in America, which is a very unique point, an opportunity to invest in an asset which is very special offering, if you like. So if I want to do that, I really need to fork out a lot of down payment, a lot of money with low yields. And not only that, the government in New Zealand wanted to cool up the housing market. So they introduced a micro-prudential tools, which is specific tools to cool the economy. Things like, especially the real estate sector, things like loan-to-value restriction. Up to about 2 years ago, they reduced the loan-to-value to 60%. Oh. So that means if you want to buy an asset, you need to bring 40% down. Now, if a house costs $900,000 in Auckland, which is where the growth was, the demographic positive outlook, then you need to bring, $350,000 to the table just to buy a house. Mm-hmm. So you don't get enough big bang for your buck in New Zealand, especially for cash flow. So my money can go much further when I go to the US. And being not based in the US, like you alluded to, we see things a bit different. We are not complacent, perhaps. We got the immigrant mentality in terms of coming and really seeing the things they are and seeing the opportunities and working hard to achieve them.
Yeah, no, that's. I think that's actually super, super vital. And it's one of the reasons that I think a lot of people don't do, especially Americans. They just take for granted the opportunities that they have. Because even just hearing that, like, Vince, as soon as he heard, 60% LTV, like, we understand the value of being able to apply some leverage, to deals, to, just like you said, to kind of make your money go further, to give you some more bang for the buck. I mean, that's nuts. But, having traveled to some of those, I've got family in Australia. I've been to New Zealand, beautiful place. But yeah, you come to experience, it's not all the same everywhere you go, especially when it comes in terms of real estate. The process is different, the rules kind of play different. And I think we take it for granted a lot of times as U.S. Citizens, or not even U.S. citizens, but just residents, right? Like, people just here. So it's like, okay, listeners, make sure you're taking advantage of these opportunities. Please do not think that these are just dime a dozen everywhere. It takes a lot of effort. It is a very, just like Hadar mentioned, it is like a special offering when you can come across, a nice cash flow producing deal. So don't take that for granted.
Yes. One of the really, really exciting things for me, Steve, is that the lending environment in the US, if you get it right and you understand how to operate it, which has been forming those relationships with those community banks, it really opens a lot of opportunities for you. Because you see, in New Zealand, for example, we have 4 or 5 major banks, which they are all like Wells Fargo, Chase. There's no personal relationship. It's like a big corporate, and they're all owned by Australia as well. Mm-hmm. So gone are the days in New Zealand when you can go in, shake the hand of the manager, and get a loan, and it's based on a personal relationship. In America, it's still there, and those community banks, they are still relationship-based offering. They're still relationship-based businesses, and I found it really, really, really great to work with. So if you build a track record with them, and they like you, and they see that you're a professional, and you know what you're doing, and you start creating a profile with them and build credit with them, which we teach as well how to do. The first thing, if you choose a market, you want to get in. And once you start deciding that you go all in, you want to open a bank account with at least 1 or 2 community banks there. So you stabilize those relationships. You took a secure, you should take a credit card, even if they don't give you one, get a secured credit card, put $1,000 in, get a $500 credit card on, and put a $10 or $15 payment subscription for some online publication. Or what I suggest always to do is put an online subscription for like the local business journal, email to you. And you keep building a track record of paying your bills, and you're building a FICO, and you're building, a good track record with that lenders. And it's really, really great, because once you got the track record, they'll help you out to grow your business. Especially when you get a hairy deal, if you need a bridge loan, or if you got a deal with a lot of value add. Anyway, you can't go to agencies. So you need those relationships in the market to help you to take the deals down. Very, very important.
Yep. That's great advice. And we just spent, doing some due diligence on property in El Paso. Yeah, we did exactly that. It's local community bank. Went and sat with, with our contact there. And like, just like how you said, it's not like, and I guess in New Zealand, it'd be like NZB or, some of the bigger, just banks, right? You can't go and just shake their hand. I mean, we literally went and had lunch with our banker. Like, we got a chance to go and kind of sit down with him, and he's willing to take the time to be able to meet with us, which is awesome.
Yeah, and they pay for it too.
Oh shoot, I paid.
I was going to say, we treat.
Man,
they always pay for my lunch.
I guess we're not buying big enough deals, I guess, yet, Hadar.
Yeah. No, I don't think. I don't know what it is, but in my case, he just took the card, and I say, well, pay. No, he's happy to pay for it. He's got the bank's card. I typically pay for like brokers and handyman and my other people on the team, but so far I just had the lenders. They paid for some reason.
Nice. I remember that next time I go to Texas.
It's that smile right there, Hadar. They're like, oh, I got to buy this guy lunch.
I had the deals, guys. My last deals, the 47 unit, I had 3 or 4 banks telling me they're going to fund it. One of them took me and my buddy Cole for lunch. And not only they took us for lunch, they came in a team of 3 or 4 people, like the lender that I'm dealing with, commercial lender, his supervisor, and another guy from an underwriting department in the branch. And it's very, very, very well-known bank in Arkansas. They took us for lunch. They paid for it. They excited. We laughed. They told us all about their hobbies. You name it. Everything went well. And they told me we'll fund the deal. But I didn't bank with them yet. But I had a relationship with them in emails and phone calls and lunch and whatever. When they went to committee, they had 14 people on the committee. And, a couple of them on the committee, they thought, who is Hadar from New Zealand, although U.S. citizen, although he's got experience, we can see he's got track record. We don't want to lend to him. And that basically all went kaput. So, and then I ended up getting a loan from the lender that I did have a relationship with, although not the best terms, but I got the deal done. And now I'm refinancing it with a credit union, which gives me better deals. But the point is, when you're dealing with community bank, I think it's very important to ask at some point, what's the loan approval process? Because if they're going to a committee and there are 15 people on the committee, it's harder to get things done if you get to a committee and you got 3 or 4 people only. So, I learned from that. And also keep your expectation aligned, because although they took me for lunch and took call and, we had a grant, the deal didn't go through in terms of the funding from them. So you really need to keep your options open, as many as you can. And the last result will always be a good local mortgage broker, which will always be able to help you and know which lender locally will be willing to accommodate your deal. It might cost you 1% instead of a 0.5% of origination fee, but it's money well spent if you can make the deal work.
Absolutely. I'm going to jump in real quick. So lesson learned from us, same thing, especially with community banks. You don't want to just build that relationship with one bank. You want to find out who all the bankers or lenders, credit unions in your market that lend on commercial. And you want to build relationships with all of them. And then when you have a deal, you're going to cast that net out to all of them and not just focus on one bank. Because same thing happened with us. We started on one of our last deals. We started with 3 or 4 banks, local banks. One seemed to pull ahead. They had the best terms. We met them. They promised all the things, the best terms, best rates, everything. And then they came back and they're like, oh yeah, we can do the loan, but it's going to be like whatever it was, like 60% LTV. Yeah. When I was like, you told me like 80% 2 weeks ago. What's up? So we had to drop that lender and go to one of the other ones. The mistake that we made was once that first lender started to pull ahead from the pack, we dropped all of the other ones and kind of put them by the wayside in the back burner. So when the one that we thought we were going to go with didn't perform, we had to scramble and go all the way back. Like, hey, I haven't talked to you in a month, but let's get this deal going again. And that was a huge lesson learned from us, is that when you're dealing with those new relationships with in a new market with new bankers, you never want to stop engaging some of the banks in favor of one until you have like a proven track, until you've closed deals with that bank. Because again, at the time, the loan originators, they're salesmen, right? They're trying to get applications. They're trying to get deals to the committee. Sometimes they have a lot of pull. A lot of times, like you said, they're going to build a package and they're going to pitch it. They're going to try to sell it to the committee, but the committee is the final say. So lesson from us, again, was if you're new to a market and you're new to building relationships with that bank, those community banks, then get all of the ones that write the loans that you want, that you're looking for, those commercial multifamily loans, and engage all of them all the way through the process. Don't favor one and then all of a sudden stop talking to the other ones. Because if that first one doesn't pull through, you're going to be scrambling to re-engage those conversations and spark up those conversations with all the people that you forgot about a month ago, and to put you in a really tight spot. So huge lesson learned there. All right. I think I'm up for questions now. All right. So I'm going to switch over to the asset management side on the stuff you do have, that Arkansas portfolio. So on the asset management side and building business plans and executing them, I'm big on kind of like a phased acquisition approach, where it's like phase 1, phase 2, phase 3 of my takeover plan. And phase 1, it's usually like those low-hanging fruits that are going to just immediately have bear fruit on increasing the NOI, either cutting expenses or like quickly adding some kind of additional stream of revenue. Because usually it's like the 80-20 rule, right? The 80-20 principle. So I'm big onto that. And I always put those things that will increase the NOI the most, with the least amount of effort right up front in my acquisition plan. So for you and your strategies, what are some of those things that you do right away on a property that you get that immediate bump in either appreciation or cash flow?
So really, I look at it in a holistic approach first up. And the first thing I want to do is really make sure that the residents that are there know that there is a new sheriff in town, new management, if you like. But they also want to know, I also want them to know that we are there to add value to them as residents. So the first thing you typically do is do external work to try and tighten in the good residents who are there. We want to make sure they stay, and we want to make sure that we're adding value to them. So it's kind of preparing the ground, if you like, to a rent increase. So we get in, we do fencing, we do landscaping, we do picnic table, we do dog park, we do a curb appeal, we put signage, we do whatever we can to show that we care, and we are starting to roll in, if you like, our service, our vision into the property. Following to that, if there is an opportunity to implement RUBS, we will implement RUBS if there is an opportunity. So that will be a straightaway opportunity to reduce your expenses. Second to that will be really doing a lease audit and seeing who of the tenant, depends, how much they're paying and how much, if they're below market, which is my favorite, is basically to find apartments which are well below market, what we call loss to lease. Mm-hmm. So we would like to give them notice to increase the rent. But, typically I will target vacant units first and residents who within the next, 2 or 3 weeks, we have a feeling that they are not performing as somebody we want to have in the community. So if you start having delinquencies, if they look a bit rough and we just see that they're paying very low rent because that's all they can afford, and they live in an apartment which is really not kept well, we will try to basically turn them over and get rid of them. That would be the best outcome for us. So that's really all we do in terms of straight away, and then we just see. Depends on the property. What kind of repositioning plan do you have? Whether you have an option to introduce cable contract, or whether you have an option to offer other services for fees. Like including pets, or getting a non-refundable pet deposit, pet rent. We found that to be kind of adding to the NOI. But really, it's focusing on resident retention, improving the demographic of the property, and increasing the rents to market. That is really the three main core things that we implement the easiest straight away.
Nice. So one of the things you mentioned was looking at your tenant base when you take over. That's one of the things that I focus on heavily too. And when I do what's called a lease audit. So I go through a lease audit and I put everything on an Excel sheet, and I try to figure out who are the residents that are going to be leaving, or their leases are up, either on month to month, or their leases are up in the first 90 days of acquisition. And I'm going to be like laser focused on their performance. Like, are they bad tenants? Are they late? Look at their late history, or their any kind of complaints in the whatever notes that the prior management had in the system. Because if they're problem residents, then I have that first 90 days to kind of put them on notice, and then just non-renew them. Because what a lot of people do, a lot of newer investors think that when they take over, they got to keep the goal is to keep occupancy really high. So they get over and they're like, okay, well, we just took over the property. We can't show occupancy dipping. We got to keep income, the revenue high. So they just auto renew everybody to get the property stabilized really fast. And what they end up doing is they end up shooting themselves in the foot, because they end up renewing a tenant early on in a resident early on in the project that they probably should have gotten rid of. And now they're stuck with that person for a whole year, or have to evict them, a costly eviction down the road. So I'm really focused on that first 90 days of who all has leases coming due, who's on month to month, what their performance is like. And that's the first part. The second part is, as you mentioned, loss to lease. So during my lease audit, I look at, okay, of those first 90 days of residents that have the potential to move out because their lease is about to expire, how far off is their contract rent versus the market rent? Because if it's like $50 or more, actually I have a conditional formatting in my sheet to where it'll automatically turn those residents red, because there's a good chance when I give them their renewal and it's, $50, $100, $150 more because we're bringing the rents up to market, that person's going to choose to leave. So on the asset management side, I'm not removing these people. They're just going to choose to leave because maybe they just don't want to spend that much or they can't. But either way, they're going to leave, and I need to budget for those at-risk tenants. I'm like, okay, there's 10 people here that are $150 under market. There's a very good chance that they're going to leave once I give them their lease renewal at, whatever the new rent is, $800 or something like that. So I will make sure we have an extra bit of budget for those turnover expenses and for that vacancy that we're going to incur. And it's really, really important when you're building your business plans and your acquisition plans for asset management to look at those things, because I think it's one of the areas that a lot of investors end up shooting themselves in the foot their whole first year, because they just they hurry up and try to renew people that probably shouldn't be renewed. And then their loss to lease is, higher than it should be. They got tenant problems that they probably should have got rid of just because they want to keep occupancy high.
Yes.
So those are some awesome points.
I would like to just add to that is that, first of all, this is one of the reasons that we like to work with community banks when we buy assets that need stabilization, because you're not restricted to 90% occupancy for 90 days and all that's Freddie, agency debt requirement, Freddie and Fannie. So that's just give you a little bit of flexibility. The other thing is that I actually like to see some month-to-month leases when I buy a property, because like you said, I'm able to monitor and see if we need to get rid of people or if we need to turn the unit. You see, the idea is to get in, and if we need to renovate apartments, we want to get on with the job if we need to. So if you took that in account and you're well capitalized, for example, let's say you want to spend $5,000 a door, and you need to do all of them or whatever amount you need. You did the inspection, you know how many units you do. So we raise that capital. In my case, it's self-funded, but we get that capital up front, whether from construction loan or whether we bring it to the deal. We know we have it. So we're sitting on it until the units are vacant, until we can go and execute the turnover, the unit turn. So it's very, very important to be able to well capitalize. And I had a situation that suddenly in 1 week I had 3 people leave. So I said, thank you very much. I'll get in, I'll renovate them, I'll take the rent from $450 to $600. And that's what I do. It didn't scare me. I didn't feel I was happy about it, because that actually allows me to execute my plan faster. And now it's been almost a year on the dot. It's actually less than a year. I'm already applying for a refi with the credit union that rejected one of my when I wanted to buy this deal. But now they're all over me. Like, they're going to give me 25-year amortization, good interest rate, and I'm going to pull, hopefully, touch wood, I'm going to pull $500,000 out, which is all my money plus extra, and it's going to cash flow the same because of the amortization, which is going from 20 to 25, and because the interest rate is going from 5.5 to 4.25. On that point, and what you mentioned is what we call the future vacancies. When we're looking on a deal and when we're actually managing a property, even long term, we always look at future vacancy. Is one of our KPIs, key performance indicators. We want to make sure, like you alluded to, which property are getting vacant or potentially going to be vacant and when. So we make sure that we do notification, which I'm using what we call, it's called an ad reminder. It's a little add-on that you can add for Google Sheet. So when we have the lease audit, create a sheet, and we have all the residents there. We have lease start, lease end. If it's month to month, it's month to month. The rents they're paying, and we put notes as month. Hey, she was late before on the rent because of COVID. She'll catch up next month. So we put the notes. But more importantly, we give 60% notice to me, my assistant, my property manager, the property manager assistant, 60 days prior to expire of fixed leases, so we can approach the resident and ask them, hey, would you like to renew? Then we know when we are going to need to turn this unit if we will need to. Very, very important, because it's risk mitigation, really. You're mitigating your risk of vacancy. You can plan ahead. So future vacancies is a very, very important key performer indicator. I absolutely agree.
Good stuff. All right, let's switch gears a little bit. So I know, and I'm in the same thing, we're in Hawaii, right? So I always get asked, like, how do we do long distance investing? And it must be so hard and all those things. So I'm going to flip that and challenge you to like, what are some of the things that investing in the US from New Zealand has actually made you a better investor? And I have a couple of my own takeaways on that question, but I want to hear yours first. So what things, has investing in the US from New Zealand has made you a better investor?
That's a question that nobody ever asked me. So thank you for asking me. I think that it's really improved my asset management skills, creating systems. There is a lot of things that I learned through the process as we go, because I had to create my own systems. I had to learn the difference as well, how things ran in the States than they're running in New Zealand. There's quite a few differences with the legality, with tenant roles, with many things, and the way things are run. Here we have in New Zealand, we have the Tenancy Act, which is basically a set thing for the whole of the country. There is no different rules in different states and all of that, and it's a bit more pro tenant than like the northern state. There's no rent control or anything like that, although they introduced it temporarily for COVID. But you kind of, there's rules, and there's rules for everybody. And this, in America, there's different rules in different states. So learning that, getting familiarized with different ways to do it. But I think it's mainly to answer your question, to do with the systems and processes I put in place. That's mainly and it makes life easier long term. So that's the main thing.
And that's exactly where I was going with that. So, and from my perspective, and you'll get what I'm saying here, is that like I've always been long distance investing. Because I'm in the military, so I had to start my entire investment career, my real estate career, with me not being there. So I had to like build the systems. I had to like, okay, how am I going to handle this issue? How am I going to handle this issue? And it forces you to build your systems, build your processes, go down like these rabbit holes of what ifs so you can solve problems that haven't happened yet, because you can't click the easy button like, oh, I'm just going to hop in my truck and drive across town and fix this, thing that happened. You don't have that option. You don't have that luxury. You don't have the easy way out. So early on, like I had to force myself to create these things to be successful. And now as I mature those systems and processes, I can see the fruits of that labor, because now things are just like, it's so much easier as I'm scaling, where when I used to go to meetups, and you'll see what I'm talking about, you hear a lot of people like, oh, well, I got a small portfolio, 20, 30 units, but it's killing me. Every weekend I'm there, every I have no time. I can't go on vacation, because they didn't build themselves a portfolio. They built themselves another job. So now they're like in this thing 10, 20 years, and now they're trying to like reverse engineer and try to like build the systems then. And I think, and get their own freedom back and try to hand those processes off, or create the processes to hand them off. And I think that's a big advantage for us, because we didn't have that luxury. We had to develop those first to even remotely be successful. So I think a lot of people that have to do long distance real estate don't think like that. They think, oh, it's just too hard. I can't do it. I'm not in the market. But the flip side of that is that if you do have the energy and you have the drive to do it, you'll be much better, once you get the ball rolling.
Yes. And the other thing is that it comes to it, and it ties within what you said, is the mindset thing. That's why there are third-party property management companies available for people to use. So as long as you know how to vet them, which one of the criteria is, well, the best criteria is to get referrals, that solves, I would say, just 50% of your problem. Then you need to manage the manager, which is another story, as you know. But a third-party property manager can save you a lot of time and effort. I mean, I have no interest dealing directly with tenants, with residents, whether in New Zealand as well. All my properties are managed remotely by a third-party management, apart from a commercial triple net building that I have here. And it's really in my backyard, and it's triple net, so there's nothing to do. Apart from here and there, some negotiation of leases and looking at some things that they want me to look. But third-party management is put you halfway there. Then you just need to learn how to manage the manager, which is not rocket science. That's why we do. We got actually an asset management course coming up through the MIH Mastermind, pretty affordable. If you go to MIH Mastermind /education, you'll see that course there in a couple of weeks, and you'll see some other freebies and other courses as well. So It's doable. You can learn that skill, and it's not rocket science.
Nice. A couple of weeks went. So we're in October 2020. So a couple of weeks sometime in November 2020.
Yeah. It will be even
out for a while. So
yeah, maybe even before that. They'll have like also an info pack, if you like, asset management pack that will have asset management checklist. It will have key performance indicators, asset management roles. That if a team is taking down a deal and they're all going to be part of general partner, they need to know also what kind of roles each one could play, and to be classified as an, if you like, active investor and not being a passive, which within the Security Exchange Commission rules could be a bit challenging. So there's going to be a good amount of information there, and we do that to help our members of the MIH Mastermind, but also we put the product out there for people to enjoy and educate themselves.
Nice. All right, last question for me. So you talk about taking down deals. Right now we're looking like we're maybe in another wave of COVID here in the States. We just got notification that Texas is going back into a 2-week shutdown thing like that. So as you're looking at deals right now, what are you doing for stress testing? What kind of KPIs? What kind of things are you doing for future rents, for vacancies, for?
So as well, in just to touch on the COVID thing, I totally agree. It seems like also I saw on the news, Europe as well. There's a third wave coming, and we don't know. It doesn't look like it's going to go away. I actually read some articles in the news in New Zealand as well. They reckon this could last for another 2 years. So the first thing that we do with stress testing is really mixing and matching different scenarios. That's what stress testing is. You want to do a what-if scenario, and you want to mix and match different scenario. The first thing that we do is the economic vacancy. So economic vacancy is, to the listener who don't know what it is, let's say you have a property which is 100% occupied, but 10 people are not paying. So you can say that you have 100% occupancy, but you have 10% economic vacancy. So that's what it is. So we do 20% economic vacancy in year one, and we even stress it out to 25% economic vacancy in year two. And we do that in two following scenarios parallel to that, which one of them is no rent increase at all in year one, which, in COVID, it's struggling, but this is location specific, guys. Very important. Some assets in some location, you can still increase the rent. I mean, we are planning, and we have been increasing some up to about June, July. We have been increasing. Now we are planning to give notice 1st of December to increase in January, because there's so much under rented that they should be able to take that $100 a month. And the way we screen our tenants is in a way that we want to make sure that we got residents that have enough income to pay the rent. So we're not going to get into that rabbit hole, but very important to make sure that you predict no rent growth. You can even predict 5% rent decrease if you like, which a lot of people do, and when we stress testing. It's different scenarios, okay? Another thing we like to do, which we do on any deal, not necessarily only with COVID, is we want to see a margin. We want to see a margin of a break-even point of 70% occupancy. That means that if there is no income coming, and if you have, for example, a 30% economic vacancy, which is 70% occupancy, the property is still going to break even, and you're not going to have to prop it up or bring money from your pocket or create a capital call. So we really don't predict any rent growth now for at least a year or even 2 years, and see how it performs. The next thing we play with stress testing is amortization. So we play with 15 years, 20 years, 25 years, and 30 years. And the reason is some community banks will only give you 20 years. It's just the nature of that, especially if you don't have a stabilized relationship with them. Federal credit unions in general, typically they're more flexible. They can go up to 25 years, maybe sometime more, because they're not regulated exactly like banks. I found them to be more flexible. Community banks, if you're proposing a deal and it's a 1960s or 1970s value add with quite an old infrastructure, they might only give you 15 years until you get that thing stabilized, because they see the life of the property being a bit shorter. So 30 years amortization, as you do with agency, that might not be something that will be available at the front end straight away. So we play with that. We played with buying at 20 and refining at year 5, or if you like, refining at year 5, that's my strategy, to 25 or 30, or even year 3 to see how it goes. Another thing we do, we play with interest rate. We play with currently historic low interest rate, 3.8%. What happens if suddenly interest rates go up back to 6, 5.5%, 6%? In 5 years, in 3 years, depends what's your loan terms that you're going to get. Maybe you're going to get 3 years fixed. So we play with interest rate. Very important. We check it at the principal and interest only. But typically, we like to implement the principal and interest because that's more conservative. We like to do that. Exit cap rate, whether we are refinancing or selling, we put at least 1%, 1.5% from the market rent. So what you're buying the property for, it doesn't matter. I mean, I bought this property that I bought in November last year. It was like close to a 5 cap, 4.8 cap or something, because it was 30% vacant. And there was on top of it, another 20 or something, 25% people who were not paying. So the income that it was generating, and it was $450 a month market rent, and not market rent, what we were collecting over there was 30% below market rent. So of course it was a very low NOI because it was vacant, the rents were low. So we're not looking on that. We're looking at what's the market rent when you want to refi or sell would be. So we stress testing on that. We're putting 1.5 point minimum on top of if we want to refi and roll the deal. And the last metric I'm going to mention is once fully stabilized, how would it perform with 100% financing? Because when you refi and roll the deal, when you're actually going through the process, you stabilize the asset, you build some equity, and now you want to pull all your money out, or even more, you want to see how it would perform on 100% of your cost if it's borrowed, if you're refining all your money out. So we do that in year 4, in year 5, even in year 3. So we really work that number. And last point is taxes. We always underwrite conservatively about taxes. You need to know what is the tax regime, if you like, what's the rules and regulation, how would the tax assessor will treat your taxes after the sale or in the next year. Because in Texas, for example, taxes are very, very expensive. Sometimes they can jump significantly. Also in Florida, upon a sale. So how do they calculate their tax review? How do they calculate their taxes in that particular state?
So we can probably, I should have just started with that question, and we could have just did a whole show on each one of those. All of those are absolutely important. One of the best strategies, so we do the exact same thing for us as well. And one of the best practices we do is we have 2 people that do the stress testing. So we have like our partner Duke, who will build the spreadsheet, build the underwriting, and then like we come in and I go and like just start poking holes through it. Because if you've ever done underwriting, serious underwriting for like hours and hours and hours and days, you know what I'm talking about. Like you just start like going cross-eyed. You start missing things just because you've been immersed in these spreadsheets for so long that when you build it, get a fresh set of eyes on them, and then they can easily spot things like, oh, what happens if you do, you right now you're projecting, a 90% occupancy year 1. Like that's probably not going to happen. Like you're going to have a lot of turnover because you're going to be renovating units, you're going to be increasing rent. So let's kick that down or something like that. Like, oh, you have your reversion cap rate or your terminal cap rate as a 6. Well, we're buying it at a 6. So that should be like a 7 because you're going to stress test for the market to be worse than it is now. So all those little things. And that's we do everything you just said. We do that as well. And we play off each other. So like if I'm doing the underwriting, Duke will come in and poke holes through my underwriting with the stress testing questions. And then the same thing just to make sure that you're getting a fresh set of eyes on it. Those are absolutely vital to being successful, because otherwise you're going to be, the worst thing you can do, especially as if you're newer, is have to do a capital call like 6 months into a deal because you didn't stress test your deal for any kind of economic downturn. And you pretty much bought it and like, okay, well, hopefully the market still rises and like nothing happens and it's sunny days from here on out, because that'll probably end your career very, very soon if you have to do a capital call so soon after you acquire because you didn't stress test the deal enough. So it's a very, very important part of the underwriting.
Yes. And one more last point to mention about this, which a lot of people, I like to pick holes in underwriting as well. That's just You have to, because if you're dealing with your own money or investors' money, you got fiduciary responsibility, and you need to make sure that you are, not looking at it in a rosy glasses. You need to make sure that you're doing your homework properly. So one of the most important thing is to really get your rent comps right, because I saw a lot of times when students and people who do underwriting, they don't get that right. And what I mean by not getting it right, I'll give you 2 or 3 examples. First example, they're looking on a comparable that, for example, is the utilities are including in the rent. So you need to make the effort to ring and do a mystery shopper and ring those other comparables management company and find out what's included. Is utilities are including in the rent? Do they offer any concessions? What's exactly going on? Does the unit have washer and dryer hookup in the unit or not? That's a massive factor. That could be $25, $30 extra on the rent, just on that. Another important point is knowing your market in terms of the location. And that's specifically important when you're looking on comparables, whether you gather them up for Rentometer or other properties, or whether you get the OM, offer memorandum, from a broker. More often than not, and we'll pick on the brokers right now for that purpose, because I've seen it so many times, they include comparables which are not comparables. And the reason is, for example, a lot of cities and towns and locations, they have like a natural barrier, like for example, a railway track or a river or something that if you pass that, it's a better area or a worse area, or south of the highway. It's, people who are local and they know the demographic, they know what's going on in the city. They will know that once you pass the railway track or once you pass this river or this highway, the demographic changes. So it's very, very important to know that when you're doing your rent comparable. Washer and dryer, unit size, unit vintage, construction, very, very important. And that's a sticky point that a lot of people over-optimistics because they got the wrong comps.
Yeah, absolutely. And you said the best way to do that is secret shop. A lot of people use like Rentometer and everything like I hate Rentometer because it is not an apples to apples comparison. You're like, oh, well, you can get $800 for this 2-bedroom because all these other ones, and you're looking at them, and you're like, that place is like class A and mine's a class C. Like it's not a comp. The Rentometer doesn't distinguish that. So I don't like Rentometer. I use like apartments.com. That way you can see the pictures to see like, okay, is this an actual like comp? What are the amenities they offer, like you said? But then the final thing I do is secret shop and then ask my property manager and like, hey, go walk the place and let me know what you think the rents could be in your experiences. That's again back to the point earlier of picking a really good property manager because they should be able to help you out with your rent pricing as you take over a property. So, but yeah, the secret shopping, that's the ticket right there. If you're not secret shopping, then you're missing out on a lot of things because you can see a lot of things with the property you're buying, inefficiencies with their management by secret shopping it, but then also seeing your comps on what they're doing right or wrong by secret shopping it. So definitely a vital part of the due diligence process.
Yes, and another point on this, which a lot of people don't know, and we just experienced on a property in Florida, is does the asset, whether the one that you're comparing to or the one you're looking to buy, does they have any like, for example, rent increase restrictions? Maybe it's low because it's a hard construction loan that they talk and they have to be affordable housing. They can't increase the rent to a certain level for many years. Maybe that's the case. We looked at properties in an area in Florida and the rents were like ridiculously high, but they had some kind of an arrangement, which we digged in. We did mystery shopping. We digged in and we found out that they had an arrangement with a local elderly people housing committee in the area that were just willing to pay them rents, which were way above market rents, significantly above $75, more. It's significant. So if you have to find those things, because if you don't and you're relying on that, you're not going to be able to implement your strategy. You're not going to be able to have a value add, and you're not going to be able to have a good deal because your assumptions are wrong.
That's definitely key. And you called it about even with like calling out the brokers too, right? Because it's like, at the end of the day, they're still salesmen, right? They're still trying to get the deal done. So, it's not necessarily they're trying to be misleading, but, that's still up to us as buyers and people in the transaction to do a due diligence, right? That's just an active piece of it. And just like you called it, you got to dig in. So that's great. Well, as we kind of wrap up here, Hadar, we're going to jump into our fire round. And so, we'll just kind of ask you some kind of rapid questions here, and we'll just give your candid response. And it's been an awesome show, though. So tons of gems here. So it's a great episode.
Thank you.
All right. So what for our audience here? What's the best book that you'd recommend other than Rich Dad Poor Dad?
Yeah, I read a lot of books. So I can't really say which book is the best book, but I'm very strong on mindset. And each person, within their journey, they need something else at a different time. Like, I can read spirituality book. I'm reading The Honeybee now. I'm thoroughly enjoying it. It's great. It's simple. It's great. It's by Jake and Gino, The Honeybee, for example. So you know what? I'll plug this because you can read it. See if you got it, Vince.
You can read
it. You can read it, and you can give it to your teenage kids as well to read it. It's really, even us that we have multiple streams of income, it's reinforced what we know. It's reinforced how you build passive income. How do you actually need to become an expert in your field and try and be vertically integrated, meaning that you have one stream with many branches going off it that all relates to each other. The Honeybee.
There you go.
I'm really, really enjoying it.
Mine's a scientist, no big deal.
Oh, like you. So I like to plug that. I'm really, really enjoying it. Flight Edge by Jeff Olson is another great one. Is a bit about mindset, what you need to do to change your life and make live a great life and make a difference and really grow. Slight Edge by Jeff Olson, and that's all for now.
Awesome.
Nice.
Oh, that's very good. So next question: what's your superpower?
My superpower is, let's get straight into it. I think asset management with real estate is asset management. I think asset management is what I excel with. But I'm also would like to mention that one of my superpowers is positive thinking and gaining clarity and staying focused. And it's something that I developed. It's not something that was always like that. But the more you mature as an investor and as a person, it's not something that we work on. It's something that really benefited me in the last few years. It's being able to focus, being able to see where we want to go, how to go, and how to make it happen. Oh,
that's great. That's huge. Yeah, and that's I like the fact that you mentioned that it's a learned thing. That it's because everybody kind of assumes, okay, well, hey, it's your superpower. Hey, Superman didn't have to learn how to fly necessarily. He just fly as a baby, right? But it's like, okay, no. This is it's such a integral part of being successful in life in general, and it can be a learned thing. It doesn't have to be a natural thing. So that's huge. All right. So what's your biggest lesson that you've learned along your journey through multifamily?
From multifamily, wow, man, I don't even know where to start. I mean, there's always everything we talked about, the lender's relationship and all that. But one of the lessons in multifamily is there's really a lot of things. But one thing I want to mention, which is important, and it's gonna be relating to a lot of people, is watch out from overcapitalizing. When you're taking on a deal and you need to renovate, whether you do house flipping, whether you do renovating apartments, know what you can do to get the results you need, but make sure that you're not overcapitalizing, that you're not spending too much money on an asset that is not required, and you're not going to get the biggest bang for your buck for the money that you're putting in. Because I'm not talking about being tight. I'm actually taking pride of the properties that I own. My third-party manager always tell me, you're one of our best landlords. You're always doing what you need to do to give good service to the tenants, and we do. But overcapitalizing is a big mistake. So, for example, we did renovation for apartments. I started with granite, $1,500 a piece. We did 5 or 6 of them, and we saw that we can get the same rent only if we resurface the countertop. Instead of $1,500 granite, we can do it for a couple of $100. So we pulled the plug on it and say, let's go with that. So, getting a close eye and really holding the bull by the horns and making sure that you really, really, really invest. If you're out of area, you just have to get involved. You have to make an effort, the commitment to visit, to be involved, and see the things the way they are. Very important. Know when to pull back with your CapEx budget if it's not necessary, because it's an investment. And if you invest it, you put it out and you're not getting a return on it, it's not necessarily worth it.
Oh, that's great. That's great advice. Yeah. And then last question. So for the busy working professional, who's working towards financial freedom, like what advice do you have?
Oh, that's a very good question. And I can give you a brief of my 5 elements of successful business that we teach in the Mastermind, if you like. I'm not going to go a lot of it, but the first thing which is very important is focus. Focus and persistent, which is avoiding the shiny object syndrome. You know, we all have shiny object syndrome. We got a slow phase in the business. You're not getting deal flow. You're not getting, even when I was flipping, suddenly I have a big breaks before drinks, if you like, and I started doing other things, and I lost momentum. So if you're focusing on one thing, and you put the processes and really going through the process of making it happen, you want to stick to this strategy and make it happen, and just be very persistent. The second thing is measurable action plan. You really want to have a measurable action plan that you can implement. And the way we do it through the Mastermind, also we teach, is we have a quarterly action plan with key performance indication. So we basically have a 3 focus area for each quarter, and we are establishing those 3 focus areas through the questions of what is important for me right now to take me into the next step that would lead me into my goal this year, that would lead me into my 5-year goal or even my 10-year goal. So you have your big goal and you walk backwards from there, but you want to do it in quarters. You want to do it in palatable sizes that you can take it down. Could be a small process of creating, for example, a broker's conversation systems, how to follow up with broker, what's the system is like. Are you going to email? Are you going to text? Are you going to call? How often are you going to do it? Where are you going to store the broker's relationship on the CRM? Who is going to implement it? Is your VA going to email them? Are you going to email them? So creating those systems to take down the actions that you want, if you like, within your focus area, those goals. The third thing is time management. You need to have a proper time management. As you guys know, we use calendars, we use weekly planners. Whatever you can, you need to schedule, because if it's not written down, it's not going to happen. So we got this, which is like Jake using Jake and Gino. We got something like that I'm using. I just printed a new one because I ran out, and I'm preparing my one for tomorrow. It's Monday here. So proper time management, know where you are. The fourth one, briefly, it's understanding your financials. Understanding your financial is very important. What you can afford. When you go into real estate, you're going to multifamily, you want to make sure what you can afford. Are you able to afford to buy a 4-plex, or are you able to afford to buy 20 units or 50 units? You want to have this discussion with a mortgage broker. You want to have a discussion with a lender earlier on. Are you going to use your self-directed IRA or EQOP, for example? Very, very important. Understand underwriting. Well, you don't have to be the underwriters of the team or be a master underwriter, but you want to understand the nuts and bolts of the deal. You want to understand how to read the deal so you know if it's actually a good deal or not. Whether you're a passive or active investor, you need to understand at least the basic of underwriting. You want to be able, as an asset management, to understand your business KPIs, tracking collection, fees, rent growth, delinquencies, all of those things. You need to understand it if you are wanting to be successful. And the last and fifth point, which you guys will agree with me, is accountability. Accountability is the glue that ties commitment to results. Many people start things, they know they need to do it, but they never end up pursuing it, or they do half a job. If you got somebody that's keeping you accountable, and helping you to achieve those goals, for example, like a mastermind, for example, like Jake and Gino, you will be progressing towards your goals. And if you don't have that, a lot of people give up and fall off. So accountability is very, very important.
Oh, that's huge. That's huge. I mean, this is just talking about, over delivering. I think that's huge. That was like a whole show right there. Just you're right. Just the 5 points. Well, it's been awesome. Yeah. Having you on, Hadar, and I'm sure like there's like that, you've got your site, and we'll definitely include all the links in the show notes and whatnot, so people can kind of follow up and get some more information from you as well. How can people reach out to you? Just so we can have that for our listeners.
People could jump on the MIH Mastermind website on the Contact Us page and can just submit a form there. If they want to contact me, just send it to me. It's just me and Marco there, so we will be responding. Or if anybody wants to, to give us a ring, they can call me on 501-251-8201. That's my cell phone in the States. And you can message me or just call me. So no problem. And I appreciate you guys having me on the show. It was great to see you.
No,
thanks a lot.
No, that's
absolutely
awesome.
Thanks for coming to us from the future of Monday, and it's Sunday there, and it's Saturday here. Right?
Yes.
Yeah.
Yes.
Awesome.
I'm a day ahead. It's amazing, but it's a good time difference. So it's a good for us. We're both in the morning, so it's not a problem.
Nice. Well, we definitely appreciate your time.
Oh,
no worries, guys. Have a good day. See you later.
Yep.
Thanks you. Thanks, Hadar. Aloha.
All right. So that was an awesome show, Steve. I told you it was going to be great. Hadar all the way from the future, because he is a day ahead of us. So he came from the future to drop some golden nuggets on us. I told you the things, the biggest things I took away, again, with those the stress testing, those KPIs, that is absolutely vital to not skip that step in underwriting. If you think you don't have the discipline to do it yourself and to do the due diligence properly when it comes to underwriting and stress testing, make sure you have a partner that can help you. Like I said, in our team, that stress testing is a 2-person project. We have one person that creates the pro forma in the underwriting, and the other person looks at it with a fresh set of eyes and pokes holes through it and asks those stress test questions of what happens if we can't raise rents? What happens if economic vacancy increases to 30%? What happens if the terminal cap rate goes up 150 bips or something like that? Like, will this deal still perform? Will we lose our money? Will we preserve our investors' capital and our capital? So it's very, very important. Do not skip the stress testing test. Definitely things on asset management. When you're building your portfolio, it always has to be from the lens of systematizing and creating processes and standard operating procedures for handling every aspect of the job. Because otherwise, like I mentioned, you're going to create yourself another job instead of gaining financial freedom for you and your family. And you're going to defeat the whole purpose of why you're investing in real estate to begin with, in most cases. And you're just going to end up creating another stressful job on top of the W-2 you're trying to leave anyway. So it's definitely the wrong way to go about it. Always go about it when you're building your portfolio. The hat of an asset manager is to create the process to where you're not going to be directly involved for every decision and action that needs to be taken. Okay. And I think that is the biggest ones I took away from this call. What about you, Steve?
Yeah, no, he had lots of great gems, and you've got to make sure this is probably one of those ones you want to go back and listen to multiple times. Hadar definitely shared quite a few different gems with us, and so go back and make sure you go back with a pen and paper and write down plenty of notes, because he's shared quite a bit of wisdom with us. So if you found value in this podcast, please subscribe so you can get in touch and stay up to date with all of the latest episodes. We'd also love it if you give a rating on Apple Podcasts or Stitcher, wherever it is that you're listening to us on the show. If you know anybody who might resonate with today's message in our podcast, and please share the episode with them. If you want to connect with like-minded investors, whether you're here locally in Honolulu or really anywhere in the world, just like Hadar is in New Zealand, make sure you're connecting with us and are joining our Facebook group, Honolulu Multifamily and More. It's a mouthful. If you're interested in connecting with us directly, go ahead and go over to tricityequity.com to learn more. See you next time, guys.
All right. See you, Steve.